Hey everybody, Brian Shannon here from alphatrends.net. It's Friday, the 31st of May, 2019, and we had a holiday shortened week, but it was a rough one for the bulls. We lost some pretty good ground in the markets overall, and the month was obviously a terrible one for equities. Bonds and the volatility index were the only thing up here. Oil down 16%, and semiconductors down 15.5%. So let's take a look at the charts. You know, one thing I talk about all the time is potential levels of support on the way down and potential levels of resistance on the way up. I never say, here's where we're looking for support. I never refer to the 200-day moving average and say there's support at the 200-day moving average. I say that's an inflection point, a level we want to be aware of for the potential of support. And when it gets to that level, what we want to do is look to a shorter term time frame to look for potential evidence of actual support there. Now, when we tested the 200-day moving average on Wednesday, we got a little bit of a reprieve. But the more important point, and what's kept me really focused on the intermediate term trends more than anything in my career, is the direction of the 5-day moving average. And if you go back to any archives that you see of my videos, you'll see that I constantly say the direction of the 5-day moving average. When we see rallies with a declining 5-day moving average, they're considered guilty till proven innocent, and we expect that they will fail in that condition. So with the declining 5-day moving average all week, it wasn't a surprise that these rally attempts continued to fail, and it's no different on the way up, that we look for potential levels of resistance and we give the benefit of the doubt to the intermediate term time frame. I don't make big grand guesses as to where the market will be at the end of the year. Instead, I like to take it in little chunks at a time. That's the luxury of being a swing trader. Now, we had been speaking about the volume weighted average price from the January peak, how that had been holding as support most of this year. As we lost that level, I was looking for the next level to be tested at the 200-day moving average in the year-to-date VWAP. We've gone down through that level. It doesn't mean that I was expecting that to be support. It was a potential level where buyers would show up, and clearly they have not shown up. We closed right at the low for the week. The next level of interest and potential support would be the volume weighted average price from the December low. If we take a look and put some Fibonacci on there as well, you can see that's approximately where we see the 38.2% retracement. Let's do this as well. Here's what makes this a even more interesting level. If we take a look at the volume weighted average price off the 2018 first quarter peak, off of the peak in 2018, and then this pullback low, you can see that those volume weighted average price levels come clustered together all in this general area, making that level, the volume weighted average price from the December low, important for a number of reasons. So I think next week that's what we should be looking for, is about the 273-ish level to be tested, and if it holds, that is the area where we can look for the ability of the market to maybe make some recovery ground in here. But with a declining 20 and 50-day moving average and below a 200-day moving average as well that's starting to roll over, we have to look at this market and be very cautious with our longs. Same is true, of course, for the Nasdaq. We closed just at the volume weighted average price year to date. Just below that, of course, we have the volume weighted average price from the January low, and we're at the 200-day moving average as well. More importantly, the intermediate term trend on the 30-minute time frame here, we have a declining 5-day moving average with lower highs and lower lows below that declining 5-day moving average, making it guilty till proven innocent. What we want to see is a flat to rising 5-day moving average before we give the benefit of the doubt back to the buyers. Russell 2000, I was talking about the potential of maybe a quick shakeout underneath this prior low in March and then a reversal. But of course, we still have a declining 5-day moving average. By the way, this moving average is the volume weighted average price for the week, which has been declining all week in these markets, meaning money has been flowing out. Clearly, that's the case when we close on the lows for the week. So where is the potential for support found in the Russell 2000? We could take a look at some Fibonacci and say maybe that will provide us some type of area where we'll bounce from. But right now, now, you have to remember that with this market, let's just go back to the daily time frame. Sorry for switching around so much. With a market below a declining 20, 50, 200-day moving average, it's guilty till proven innocent, and it's easier to make money after failed rally attempts. In other words, if this market rallies up, just as we had seen right in here, to a declining 5-day moving average, then we want to look for the failures and get short in there. If you're not comfortable being short, you're better off on the sidelines in cash. These semiconductors have gotten annihilated here this past month. Again, they were down 15 or so percent, below every single level of potential support that people have pointed out including myself, over the last couple of weeks. And it's one thing to look for the potential of support rather than just guessing and saying, okay, I'm going to buy here because it's a 200-day moving average. That is uneducated, in my opinion, without confirmation from a shorter term time frame. Now, here's what I was pointing out for subscribers. By the way, I do analysis of the markets every single day for just $250 a year. I do about a 5-minute video on all of these indices at alphatrends.net. Anyways, what I was talking about is the potential that we could hold above the 5-day moving average, and maybe it would be in a position to bounce. Clearly, the market did not do that today. It closed near the low of the day. It's one thing to have a scenario. The other thing is to act upon it, and we wait for actual price evidence on the shorter term time frame before we decide to get involved. So let's say next week the market were to, the semis were to do this. If I were to buy here, I wouldn't just buy blindly. I'd put my stop underneath the relevant higher low for the semiconductors. IBB, I've been talking about this as being the weaker group for a while, and it continues to make lower highs and lower lows on the daily time frame. It's approaching the 61.8% retracement of the December low to the January high. It's been below the key volume weighted average price levels for a while, so it continues to be in its own downtrend here. Lower highs, lower lows. Look for the potential of resistance at these levels. If it breaks above them, it turns the market more neutral. It does not turn it positive, not when we're looking at the shorter term time frames. And you have to know your time frame and listen to your time frame rather than just getting advice and getting ideas from every source out there. I specialize in the intermediate term time frame. I frame it around the longer term picture, and I don't get every trade right. I don't get every market call right. But when we have a declining 5-day moving average, we're in a better position to fail than continue than reverse. And as as I pointed out back here, what the potential for a bullish scenario would have been is had we gotten above there and then moved higher. We never did that. We gapped lower. We broke below this level. So that scenario does not get acted upon until it confirms through price. It didn't do that, and the market continued along the path of least resistance on the intermediate term trend, which of course is lower for the financials. And if you look at Goldman Sachs, this thing is a disaster. Look at the weekly time frame of it. It's falling off a cliff here. Now, maybe it gets a bounce, but most likely, if it gets a bounce, what's most likely in my mind is something like this, a pattern of lower highs and lower lows. Apple has broken. We talked about the potential of buyers showing up at the year-to-date volume-weighted average price, which is the same area where we see the volume-weighted average price from the December low. We also spoke about Fibonacci, saying, here's a 50% retracement in that area that makes it a more interesting area. That is a level of interest. But when we look at the 30-minute time frame, again, these are old drawings I had put in here. The direction of the 5-day moving average continues to be lower. There's no reason to be a buyer. If next week it gets back above this level, one, I wouldn't purchase it on Monday if it went above there because it would be extended. I would rather see it maybe get up slightly through it, pull back, create a higher low, have that 5-day moving average flatten out, then purchase it over here. But then I would have a stop underneath this level. That is the way I continually approach this market consistently over the years. Look at Google. Google is a mess too. Google's below all of its declining moving averages. Looking at a weekly time frame, it's a difficult looking stock that even if you get a decent bounce, it's most likely to do this. So the message of the market is we're in a period of profit taking. How long? it lasts is anyone's guess, and that's all it is a guess. Let it bleed out. Let the market tell you from a shorter term perspective the levels of interest, and then wait for price confirmation before you actually get involved.